Yes, people, welcome back after the break. So we'll start with the new topic for today, financial instruments. This is a standard which covers three Ind-AS, or this is a topic which covers three Ind-AS. Ind-AS 10, okay, Ind-AS 109, Ind-AS 32, and Ind-AS 107. Okay, if you cover this topic, three Ind-ASs are done. All right. So, financial instruments. Have you heard this term before? Or first time? Financial instruments. The name. Have you heard before or first time you are hearing? I think this was definitely not there in our CA inter syllabus. So, it is something which is there exclusively in CA final syllabus only. Alright. Again, this is an important chapter. One of the big ticket topic in our CA final examination, has significant weightage and takes quite a lot of time to cover as well. Quite lengthy. Okay. All right. So what is this? So before we dive into the topic, I'll just give you a little maybe background. What is this? Why the standard was necessary? Anta? So I'll draw up a balance sheet for you. Remember in your golden days, maybe in your bachpan, 11th or 12th. I think even 11th and 12th now the format has changed. Long before, now you used to present balance sheet in liabilities, amount, assets, amount format. Do you remember this format? I don't know, at least in my bachpan I used to do this. Maybe in your bachpan, I don't know. Have you done the balance sheet in this format before? Yeah. Or a statement of affairs you must have done in your single entry system in your CA intermediate at least. Yeah. Okay, no problem. You have done means great. Okay. So I'm just drawing the balance sheet in that format just for the sake of our understanding. Okay. All right, sir. So let's say we have a property, plant and equipment. We have an intangible assets. Okay. Some assets, components I'm bringing it in. Okay. Then you have some investments. All right. Let's say we have some current assets. Current assets could be your debtors, bill receivable, etc. On the other side, we used to write shareholders, funds and equity share capital, reserves and surplus. Then we used to have a non-current liability, and then we used to have some current liability, or maybe. Then we used to have some non-current liability like debentures. Then we used to have current liabilities like your creditors, bills payable, bank loan, etc. etc. Correct? Okay. Now tell me, sir, do you have any Ind-AS for property, plant and equipment? How to recognize PP, what to recognize, when to recognize, or what to disclose, etc. etc. Does any standard cover it? Yeah. For PP, we have Ind-AS. For PP, we have Ind-AS 16 that talks about it. Okay. For intangible assets, we have Ind-AS 38 that talks about it. Great. What about investment? What about investment? Don't say accounting standard and all. Accounting standard 13 and all is applicable there. I'm talking about Ind-AS. Have you heard about any Ind-AS so far? Me telling? Any Ind-AS? No. Okay. Do you have any accounting standard, or for that matter, Ind-AS for current assets like a debtor? I'm not talking about investment property. Someone is saying Ind-AS 40. That is for investment property. I'm talking about investment. Let's say investment in equity shares. You purchased some company ka equity shares as investment. Does any standard cover this? Not that we know of or discussed of so far. Yes. What about current assets? For debtors and bill receivable. Do you have any standard? No. What about creditors and current liabilities, debentures, creditors and all? Do we have any standard? What about equity and all? Do you have any standard? No. That means there are many components in balance sheet which are not covered by any Ind-AS. You know which Ind-AS has come to the rescue now? Or which topic has come to the rescue? Financial instruments. So all these guys, where we put question mark, all these guys will be covered under the topic that we are starting with now called financial instruments. Okay. So this basically this topic. Topic name is financial instruments. The Ind-AS that comes under financial instruments are these three. Okay, fine. So that is the background behind. Many things were missed out. So that has been brought into the financial instruments wala topic over here. Is that clarity has come in now? That's the reason for this new standard addition. Okay, that is one. So a lot of new things will probably come into the standard. So new definition, new things, new applications, etc. etc. We'll go a little slow and you participate with me. Okay, there are many things probably you may have to remember it as a memory. Okay. So we'll try to do that also, memory exercise inside the classroom. Going home and just revision. That should be our motto. Okay, every learning aspect, whether applying it, knowing logically, or knowing something by heart, or whatever, everything we will do it in the class itself. Fine, whatever means. So you keep telling with me, keep interacting with me, saying where you are, have any doubts, or are you understanding, are you able to recollect, etc., etc. Frequently I'll be in touch with you. We'll go a little slow. If you want me to go further slow down, do not hesitate. Fine. Okay, let's get to the meaning first. What does this word financial instrument mean? Sir, I'll call financial instrument as FI, okay, for class purpose. So financial instrument is very simple. Financial instrument means it is a contract. Financial instrument has to be a contract. This contract will either create financial asset to one company or one entity, or it will create a financial liability or equity to another entity. That's all is the meaning of or definition of financial instrument. Let's tell it once again. Financial instrument means it is a contract. It should arise as part of contract. That contract will give rise to FA. FA as in financial asset to one entity, financial liability or equity to another entity. Same thing is being written over here. Okay? Everyone okay? That's the first part of it. I know that you have not got, but whatever I said, are you able to little bit went in? Okay? Alright, the key word there is contract. So for you to call something as financial instrument, the key word is contract. Something which does not come as part of contract. Something which does not arise as part of contract is not a financial instrument. Is my statement right? Something which does not arise as part of contract is not a financial instrument. Is my statement right? Yes. So what is the example? Income tax. You have to pay some income tax to the government. That means you have an obligation. You have an obligation to pay tax to the government. Correct or no? Can you say income tax is a financial instrument? Does a company have any contract with the government? They will pay this much tax that day. Like, is that tax a contractual obligation or is it a statutory obligation? Is income tax and all a contractual obligation or SO, statutory obligation? It's a statutory obligation. Yes or no? So income tax obligation and all is not a financial instrument. Did we understand? Because it doesn't arise as part of contract. That's one thing. First part, is it clear now? So again, let's recap. Financial instrument means what, sir? One, it should arise as part of contract. And due to this contract, it will create what? Either it will create a financial asset to one entity, financial liability or equity to another entity. Something which doesn't come as part of contract is not a financial instrument. The example could be your income tax. Okay. This is the first thing. We learned it here. Now, the second question that will be running in your mind is, sir, what is financial asset? Today's discussion, we're going to be talking about these three only. What is financial asset, financial liability, equity, and we'll take up some problems relating to that. That's probably today's scope. Fine. All right. Let's spend some time on this. So the next aspect is, sir, what is financial asset? Sir, if I have to take in layman terms, financial asset means anything to do with cash. Anything to do with what I told, sir? Don't tell I and all told this. Okay, this is just a way to remember it. Anything to do with what? Cash. Anything to do with cash is a financial asset. So financial asset, they have given some categories, or what and all comes under financial asset, they have defined. We'll go through that. One, is cash a financial asset? Let me ask you this question straight away. Is cash a financial asset? Financial asset means anything to do with cash. Is cash itself a financial asset? Very much yes. So if you have cash including bank deposit, cash including bank deposits. So if you have any deposits in bank, that is also a financial asset. If you have cash in hand as well as cash at bank, both are financial assets. First part is clear? Okay. Cash. Second one, equity instruments of another entity. Equity instruments of another entity. Meaning, if you purchased, in my example, do you remember? We purchased some equity shares of another company as an investment. So if you have purchased, that only we call it equity shares, we call it as an equity instrument over here. If you have purchased equity shares of another company as an investment, that is also specifically brought into the definition of financial asset. Actually, it doesn't meet the definition of financial asset, but specifically bought in for the sake of coverage. Okay, there's a specific inclusion. Otherwise, investment would have got left out. So, okay. So if you purchase some equity instruments of another company as investment, that is also a financial asset. So far there with me? Cash, equity instruments of another entity. Done. Keep responding, everybody. I want your continuous appraisal over here. because everything will be new. Everything we'll learn here only in the class, and we'll remember it also. At the end of the day, we will see. Yeah, I'll give you a recap of everything. You tell me you are able to recollect or not. Okay, third one is, okay, it is neither of them. Then there's another one. It's a contractual right to receive cash. A contractual right to receive, or maybe I'll write it like this. A contractual right to receive cash or any other financial asset from another entity. It's a contractual right to receive cash or any other financial asset from another entity. That's what they've given over here. So what do we mean by this? Okay, look at this example. I'll give you a small example. So let's say there is a company X Limited. They are having a debtor for 10 lakh rupees in their books. In their balance sheet, they have a debtor's worth 10 lakh. Is a debtor a financial asset? What do you think? Is a debtor a financial asset? So financial asset means, what did I say? Anything to do with cash. That's an easy way to remember it. Anything to do with cash is a financial asset. Is a debtor and cash same? Debtors and cash are not same. But you have what? You have what over here? You have a contractual right to receive cash from debtors. Yes or no? Debtors means he has not yet paid us the money, but at some point of time he will pay the money. That means we have a right to receive that cash. So that right to receive the cash is also a financial asset. Did we understand that? Today he might have not paid, but in some time, maybe weeks time, months time, he will pay us cash. Yes or no? So debtor is also a financial asset. Comfortable? Okay, let me give you another example. Bill receivable, you have 5 lakh rupees. Is this a financial asset? Is bill receivable 5 lakh rupees a financial asset? We have a bill receivable. Do we have, what is this? Everyone answer. Bill receivable means what, sir? Bill receivable will have some term. 2 months, 3 months or whatever. After 2 or 3 months, once the bills gets matured, what will happen? We will surrender the bill and the other party will pay us cash. We will give the bill to somebody else and somebody else will give us the cash. Yes. So that means, do you have contractual right to receive cash? Very much yes. That means this is also a financial asset. Perfect. I think now you got the meaning of it. So let's, 3 things we have seen so far under financial asset. What are those? Cash, including bank deposits. Equity instruments of an other company if you have purchased as investment, specifically brought in the definition. So financial asset. Third one, it is not a cash, but you have a contractual right to receive cash. You have a contractual right to receive cash. Is that a financial asset? Yes. Sir, contractual right to receive need not be in cash. It could be contractual right to receive cash or any other financial asset. Meaning, let's say our debtor, here the debtor is there, no? That debtor told me, I don't have cash. Take my company ka equity shares. Take my company ka equity shares. Now, is this a financial asset? You have sold goods to debtor worth 10 lakh rupees and that debtor in the contract only has told that he will not settle this 10 lakh by paying cash. He will settle this by giving his company ka equity shares to us. His company ka equity shares he will give to us. That means, do we have a contractual right to receive cash here? Do we have a contractual right to receive cash from our debtors? No. We have a contractual right to receive what? Equity shares of his company. Is this a financial asset? You tell me. We discussed this already. Is this a financial asset? Very much yes. Why? Because equity shares of another company are what? Second definition, second pointer only we saw. Equity shares of another company are also financial asset. Comfortable? So if you have a contractual right to receive cash or any other financial asset for that matter, that contractual right also becomes your financial asset. Like that. Now, the same example goes over here. Debtor, instead of paying cash, he gave us bill receivable. Instead of paying us cash, he gave a bill receivable. So that is also a financial asset. A contractual right to receive any other financial asset. Is bill receivable a financial asset? Yes. So contractual right to receive bill receivable is also a financial asset. Like that. That is the third aspect. I think 3 part of it is completely clear for us. Done, no? Next one. Next one is a contract to exchange financial assets with financial liability under favorable condition. If you have a contract to exchange financial asset with financial liability or 2 financial assets, doesn't matter. If you have a contractual right to exchange financial assets and financial liability under what condition? Favorable condition. Then such a contract is also a financial asset. That's what they've given over here. Exchanging financial assets, financial liability under favorable condition. Okay, understood? Understood or Goinda? Nothing we understood, sir. Oh, I'll give you an example. Sir, let's say A Limited, they have debtors worth 10 lakh rupees. This company has a debtor worth 10 lakh rupees. Okay. This debtor told, I don't have cash. Can you accept bill receivable? That debtor has some bill receivable. Okay. He gave it to us. All right. Fine. Or, okay, 1 minute. Hang on. Can I take this example? Or 1 minute. I think that will be better. I think. This one. I think this I may modify. This I think would be a better example for financial liability. I'll modify it. Hang on. Let's say this company has a bill receivable worth 10 lakh rupees. I'll modify this. I think this will be better suited for here. So the company has a bill receivable. Sir, is bill receivable, what is the nature of bill receivable? Can you tell me now? Now you don't tell me asset. Now you have to always tell me whether that asset is a PP, OP, IP, FA means financial asset. Like that you will tell me. Okay. So what is bill receivable now? A bill receivable is a FA as in financial asset because we have a contractual right to receive cash. Okay. We have, let's say a company has a bill receivable worth 10 lakh rupees. The same company, no, they also have a creditors worth 10.5 lakh rupees. The company has a right to receive 10 lakh rupees from this bill receivable. Okay. They have to pay creditors how much? 10.5 lakh rupees. So creditor is what, sir? From creditors, we have a right to receive cash. From creditors, we have a right to receive cash. No, we have an obligation to pay cash. If you have a right to receive cash, if it is a financial asset means a contract where you have obligation to pay cash will be what? Right to receive cash is financial asset. Obligation to pay cash will be obviously financial liability. We'll also spend time on financial liability, but more or less now you got the meaning of it. Financial liability means obligation to pay cash is there. Done. Now, A Limited told the creditor, company, we are telling the creditor, boss, I have a bill receivable, but I have to pay you 10.5 lakh rupees. Instead of paying cash, I will give this bill receivable to you. Can you accept it? Okay, I have a bill. We are telling, I have a bill. I'll give it to you. Okay, in exchange for your settlement. Okay. Now, creditors, we are settling. How? How are you selling creditor now? By paying cash or by giving another financial asset? You're exchanging financial asset, financial liability. Yes or no? Now, tell me, A Limited under this scenario will have a happy face or a sad face? On this exchange or in this scenario, A Limited will have a happy face or a sad face? Happy face. Why? Sir, we have to actually pay the creditor 10.5 lakh. How are we settling this liability? By only giving bill worth 10 lakh. Instead of paying 10.5 lakh, we only paid 10 lakh. No, that means 50,000 gain for us. That means this is unfavorable scenario or favorable scenario? Favorable scenario. Such a contract is also a financial asset. A contract to exchange financial assets, financial liability under favorable condition is also a financial asset. Did we understand the meaning of that term now? Everyone? Could be anything. Financial asset exchange with financial liability, FA with FA, FL with FL, any combination is okay. But if you are exchanging under favorable condition, such a contract is also a financial asset. That's the fourth point. 4 points. Okay. All right. Fifth and sixth. Fifth one is derivative. Derivative will cover it later as a separate topic. For now, just know that derivative could be a financial asset and also it could be a financial liability. How? We'll talk about it in separate. Maybe after 4 or 5 days when we come to derivative topic, that time I'll tell you. For now, do not worry about that. Okay. Or it's a non-derivative contract where the entity is obliged to receive variable number of equity shares. This also I will just put it on hold for the time being. Okay. These two, we'll see that. So let's go one step back. Okay. So 6 components we saw as a financial asset. What are those? Financial asset means first is a cash. Cash includes bank deposit. Second one, equity instruments of another entity. If you have invested in equity shares of another entity, that is also financial asset. Third one, a contractual right to receive either cash or any other financial asset from an other entity. If you have a contractual right to receive cash or any other financial asset, that is also a financial asset ka definition. Then exchanging financial asset, financial liability under favorable condition. To exchange financial asset or financial liability under favorable condition. That's one. Fifth one is derivative. We have not discussed that. It's okay. Last one is non-derivative contract, where you're receiving your own company ka shares, but variable number of shares. Okay. For now, this is the thing. How to recognize and all, do not worry. In this topic, no, a lot of new things will come. Do not jump guns. Okay, we are in definition stage now. We'll spend a lot of time in definition and understand it fully. There are various methods to account each of them. In fact, 3 methods. Financial asset, you can use three methods. Recognition, etc., etc. Do not worry. We have 100 plus problems for this topic alone. More than 100 problems. So, a lot of things are there. Aram se we will go because entirely new. Let's learn it properly. Just restrict your thinking, especially with this topic, no? Just restrict your thinking only to the things that I'm saying. Don't overthink, because everything will come, but at its own pace. Now, if you think too much, neither you'll understand this nor you'll go there. Only this, if you do it, it's okay. One by one, everything will fall in place. That's the way this topic has to be studied also. Too many things, that's the reason. Okay. All right. So these are the things that we saw. So now you got to know what is financial asset. In layman terms, financial asset means what? Anything to do with cash. Okay. So examples and all they've given over here. Done now. All right. Now let me give you a small example. This time you told you have understood the definition. Now I'll give you some example. You will tell me whether it is financial asset or not. Done. Property, plant and equipment. Is it a financial asset? Property, plant and equipment. Is it a financial asset? Everyone respond. Yes, no, whatever comes to your mind. Okay. No. All right. Intangible asset. Is it a financial asset? Intangible asset. Is it a financial asset? No. Okay. I'll give you an answer for this and then I'll proceed with the example. Carry on. Then you tell me the right answer. Okay. PP, intangible assets, are not financial assets. Why? Sir, I told what? Financial asset means anything to do with cash. Anything to do with cash. By holding property, plant and equipment. Just by having property, plant and equipment, will you get cash? Like ArivuPro Academy, we have laptop, we have camera, we have TV, we have AC, we have sofa sets. Just by holding them, will anybody pay us cash? Just by having them, will we get cash? No. Either we have to sell them or we have to use them. Then only we will get cash. Correct or no? Either these instruments we have to use to give some service or generate a product, then sell that product to get the cash. Correct? Just by holding them, will we get cash? Just by holding them, will we get cash, or we need to use them? We need to use them or sell them to get it. Yes or no? On that ground, it is not a financial asset. Everybody understood that? So both are not financial assets. PP and investment property, intangible asset, etc., etc. Okay. Now, let me give the next example. Inventory. Is inventory a financial asset? Is inventory a financial asset? Yes or no? Inventory a financial asset? No. Inventory is not a financial asset. Why? Sir, just by holding inventory, will you get cash or you need to sell them? Just by holding cash, will you get inventory or you need to sell them? Only by selling inventory, you will get cash. Like a debtor. Here I'm having a debtor worth 10 lakh rupees in my example. Yes or no? Should I have to do anything here? No, just by having debtor, I will receive cash. Correct or no? Just by having debtor or just by having bill receivable, I'll receive cash. I don't have to do anything much there. But in case of inventory and all, no, just by having inventory, I will not get cash. What I have to do? To get cash, I need to sell them. Hence, they are not financial asset. Understood, sir? Understood, everybody? Those of you who said yes, they are not financial assets. Sir, how is equity shares of investment in equity shares than financial assets? That's what reason I told. Have investment in equity shares. Actually, is it a financial asset? You tell me now. If you purchase investment in some company equity shares, if you buy, is it actually a financial asset? No, because just by holding it, you may not get cash. Because a dividend is at company discretion. And if you want money means you may have to sell it. But it is specifically included in the definition. Hence we brought in. Everybody understood? So equity shares of another entity is specifically included in definition. That's the reason. That's the reason they had to bring in that definition. Okay. Everyone is okay with this, I hope. Okay. So that means now you got it. What is financial asset? What is not a financial asset? Clear? No? Okay. You remember this word ROU? What is ROU? Somebody saying we get dividend. Sorry. Yeah. Dividend is company discretion. No? Dividend is company discretion. If you own Infosys ka share means you will get dividend. Huh? Every year I will get 1 lakh dividend. Is it so? No. If Infosys declares a dividend, we will receive it. Otherwise, no or not. So that is debatable. Whether we have a right to receive, we have a right to receive cash. But will it generate the cash? May not be. That's the reason they brought that in the specifically in the definition itself. Okay, to avoid that ambiguity. Okay, all right. Come back to this now. ROU. What is the full form of ROU, sir? ROU means right of use. Who gets this right of use? Lessor or lessee? Who gets this ROU? Lessor or lessee? Lessee has ROU, yes or no? Whenever a lessee takes an asset on a lease, he has to recognize ROU we had discussed. Is ROU a financial asset? If lessee is showing ROU, right of use in his books, is that a financial asset? No. Why? Just by having this asset, lessee will not get any cash. He has to use this asset to produce some goods or give some service and then generate cash. Correct or no? Just by having it, he will not generate cash. Hence, it is not a financial asset. Okay, that's what they've given here on. All right, let me take this up a little ahead. Sir, a company is there. They have paid the salary to the employees in advance. They paid a prepaid salary of 10 lakh rupees. Normally, you show prepaid salary under current assets. Do you remember? We show prepaid expenses and all under current asset side of balance sheet. So this company has paid prepaid salary of 10 lakh to its employee. Is this prepaid salary a financial asset? Is this prepaid salary a financial asset? Everybody. Answer. Yes or no? You're showing it as an asset, current asset. Is this current asset a financial asset is what I'm asking. No, it is not a financial asset. Why? Sir, your prepaid salary, meaning let's say May month ka salary, or yeah, let's say June month ka salary I paid in May only. This company, they were so happy with their employee that June month ka salary they paid it in May only. So it's a prepaid salary. So prepaid salary is not a financial asset because financial asset means what, sir? You should have a contractual right to receive what? You should have a contractual right to receive cash from employees. Do you have a right to, obviously your paid salary means you have a right to receive something from employees. You have a right to receive what from the employees? Cash or service? From the employee, we will get service. We won't get cash back. Yes or no? Employee has to come and work with us. We have a contractual right to receive service from him. Do we have contractual right to receive cash? No. Hence, prepaid salary is not a financial asset. Everybody understood? For that matter, even any prepaid expenses. If you paid prepaid expense, we have a contractual right to receive some service. Okay, so that's the reason it is not a financial asset. Hope that's clear. Can I go further? People, working. I'll give you another example. Sir, let's say we paid some advance to creditors, 10 lakh rupees. We wanted to buy goods from our creditors, but our creditor is very clear. He told, give me advance, then only I will take up your order. I work on an advance basis. Maybe the actual value of the goods is 90 lakh rupees. The total purchase value is 90 lakh rupees. But creditor told, I have to first produce the goods. Later, if you back out or cancel the order, it will be a problem for me. So hence, give me an advance. Only when you give me the advance, I will start producing the product and then I will deliver it to you. So we gave 10 lakh advance to the creditors. Okay. Is this advance? Actually, if you have given is this advance a financial asset for us? Because the journal entry will pass as advance account debit to bank. Our advance account debit to bank we will pass. So this advance account will have a debit balance. You'll have to show it under current asset side. So is this advance a financial asset? Is this a financial asset? Yes or no? Majority of telling no. Why no? Correct only. Why no? Give me the reason for it. I'm happy with the answer. Can you illustrate with reason as well? Perfect. This is not a financial asset. Why? Because here will we receive cash from the creditors? No. From creditor, what will we receive? We have a contractual right to receive goods. Yes or no? We don't have contractual right to receive cash. We have a contractual right to receive goods. Hence, it is not a financial asset. Okay. Awesome. Sir, suppose if this contract cancels means, suppose the contract gets cancelled. Then the contract gets cancelled means will creditor give us the goods? Creditor will not give us the goods. But we have already paid a 10 lakh rupees to advance to creditors. Now will we keep quiet? Now what will we say? Since we have cancelled the contract, what will we tell the creditor now? Pay me 10 lakh rupees back? Yes or no? Now tell me. If contract gets cancelled means how will you treat this advance? Now on this advance we have a right to receive goods or we have a right to receive cash. This advance will be repaid to us back. I mean now we have a right to receive cash means now will it become financial asset? Yes. Like that. Okay, so you have to interpret like that. Dana people, I hope this financial asset ka discussion was fruitful to you. You have understood everything. Yes, no? Correct? What is financial asset? What is not financial asset? That's what we have. Our discussion was limited. Almost half an hour we spent only on this. Okay, because important. Once you know the meaning, then accounting treatment we can build upon it. These are new, so I want you to be absolutely clear on these topics. Okay, great, sir. So I'll tell you some more examples or questions. You tell me. A simple thing you have to tell me is financial asset or not. A Limited has makes a sale of goods to the customer on a credit of 45 days. We have sold goods to data, credit sales. The customers are entitled to earn a cash discount of 2% if payment is made before 45 days. Interest at 10% is charged for payment after 45 days. Credit is 45 days. Before that he pays, we will give him some discount. If he delays the payment, we will charge some interest. Company does not have a policy of selling its debtors and holds them to collect contractual cash flows. Don't worry about this sentence. Okay. On debtors, we can do something called factoring, where we can sell, a company can say, you might have learned it in your FM. Okay. A company can sell its debtor through a factoring to a factor guy and recover the money. This, they are saying we have no intention to do that. Basically, forget about the other things. Is debtor, company has already sold goods on credit, means we'll have debtor. Is debtor a financial instrument? If it is financial instrument, which financial instrument specifically? Is debtor a financial instrument? Yes. Which financial instrument? Yes, it is a financial asset. Like, that's all they asked. Don't worry about the accounting. Accounting, we will not get to it. For now, we'll limit our discussion only to the definition. Yes or no. That's all it is. Can I move on to the second question, people? Okay, second question. Z Limited, it's a company. They have sold goods to customers on credit. Goods are carried in large containers for delivery. Maybe the goods are a little hefty or something. So we are shipping it in containers to the dealer's destination. All the dealers are required to deposit a fixed amount of 10,000 rupees as security for the containers. Okay. So we are collecting, since we have to ship the goods in containers, maybe in big drums or something, we are shipping those goods. Maybe it is oil or something, we don't know. So we are taking that containers will have some value. No? Later, if the customer doesn't return the container to us, it's a problem. So this company, the selling company, has collected some fixed deposit, some advance from the customers as security deposit for the containers, which is returned only when the contract with the company terminates. Once the contract is ended, we will give back this amount to the whatever customer. Deposits will carry 8% per annum interest, which is payable when the contract terminates. Okay. If the containers are returned by the dealers in the broken condition or damaged cost, appropriate adjustments will be made. We will deduct the damage cost and then only pay the balance. How such deposits will be treated in the books of dealers? The dealers. That means we are talking, let's say A Limited has sold goods to B Limited. Okay. Now what? A Limited has to ship the goods. If A Limited has to ship the goods, means before shipping, A Limited will collect some money, security deposit from B Limited. So B Limited has given a security deposit of some amount, 10,000. So they are asking in the books of dealer, this guy is a seller. B Limited here is the dealer. In dealer books, how will you treat the security deposit is what they're asking. For dealer, what is it? Is it a financial asset? Is this a financial asset for dealer? Yes, it is a financial asset. How? So once the contract terminates, what will happen? A Limited will pay fixed deposit back to the dealer. Yes or no? That means the dealer has a contractual right to receive cash. They have a contractual right to receive cash. When and our period is irrelevant. The funda over here is, do we have a contractual right to receive cash? Year 1, year 5, year 10 doesn't matter. Do we have it? Yes. If you have a contractual right to receive cash, it's a financial asset. That way. Period is irrelevant. Don't get confused by the period. So to answer your question, yes, it is a financial asset. The security deposit for B Limited is a financial asset. Just curious, for A Limited, can you tell me what it will be? For A Limited, what it will be? Is it an asset? No, they have an obligation to receive cash or they have obligation to pay cash. A Limited does not have obligation. They have already received cash. They have an obligation to pay back the money. Yes or no? That means for A Limited, what it will be? It will be a financial liability. Though we have not gone to financial liability section, I hope you are able to decode it. Okay, they ask for dealer, what is it? For dealer, it is definitely a financial asset. Okay, awesome. Any doubts or next question? Okay, third one. Interesting enough? Learning something new? Yes. Excuse me. Okay. A Limited issues a bond. One company, they've issued some bond or debentures. Principal amount to see you 1,000 rupees per bond. Okay. All right. The terms of the bond require an annual payments in perpetuity at a stated interest of 8% per annum. A company, they've issued some bond or debentures. The bond has maybe a face value of 100. That's what they mean by principal, maybe. It's all right. The C is a currency. Maybe this question was copied from some foreign book, I think. Okay. That's the reason. Okay. Leave that. It's fine. So on this bond, the company has to pay an interest of 8%. Perpetuity. Perpetuity means forever. Maybe these bonds are not redeemable bonds. You have something known as irredeemable debentures or irredeemable bonds. Maybe these are irredeemable bonds. So hence you have to pay interest till perpetuity, meaning forever, at 8%. Okay. Assuming 8% is the market rate of interest when it was issued, the issuer assumes the contractual obligation to make a stream of future interest payments having a present value. Okay. They're saying company will pay interest. Evaluate financial instruments both in the hands of holder and issuer. A Limited, they have issued some debentures to the investors, to various guys. On this debentures, you have to pay 8% interest. So for investor, can you tell me what is this? What it will be? Investor has invested in debentures of A Limited. Does investor have any contractual right to receive cash? Does investor have any contractual right to receive cash? Yes, he has contractual right to receive cash in the form of interest. Frequently, maybe annually, monthly, or whatever, investor will get interest from the company. So he has a contractual right to receive cash. So for investor, what it will be? For investor, this debenture invested in another company is a financial asset because contractual right to receive cash is there. What about A Limited, the issuer? This guy is the issuer. This guy is the holder. For the issuing company, they have a contractual right to receive cash or pay cash. They have a contractual right to receive cash or obligation to pay cash. They have an obligation to pay cash. That means this will be a financial liability for A Limited. That's what they asked. For holder, it's a financial asset. For issuer, it's a financial liability. That's it. That's what we have discussed. So with this, I think we have done some illustrations regarding financial assets as well. So let's go one step back again. What is the topic name, sir? Topic name is FI. FI as in financial instrument. Financial instrument means what? It is a contract which gives rise to what? Either a financial asset to one entity and financial liability or equity to one other entity. So it should arise as part of contract. Something which doesn't arise as part of contract is not a financial instrument, like your income tax obligation. Then we looked at financial asset. Financial asset means 6 features. 1, cash. Is cash a financial asset? Yes, including bank deposit. Then equity instruments of another entity. If you purchase equity shares of another company, it is also a financial asset. Third one, a contractual right to receive cash or any other financial asset from another entity. That contractual right to receive cash or any other financial asset is also a financial asset. Fourth one, to exchange financial asset or financial liabilities under what condition? To exchange financial asset or financial liability under favorable condition. Happy scenario, gain scenario. If you're exchanging, it's such a contract also will become financial asset. Fifth one is derivative. Internet lost. 1 minute. Internet is lost. Guys, you are able to hear me now? I think we lost. Guys, you are able to hear? I think we again lost some internet connection there. We were discussing the definition of financial asset. Basically, cash is a financial asset including bank deposits. Equity instruments of another entity is also financial asset. Third one, a contractual right to receive cash or any other financial asset from another entity is also a financial asset. To exchange financial asset, financial liability under favorable condition is also a financial asset. Derivative is also a financial asset. A non-derivative contract where the company is receiving its own equity shares but variable number of equity shares is also financial asset. That's what we learned and applied it in few problems. So let's get to the second aspect of it. After financial asset, the second aspect is what? Financial instrument, it only talks about three instruments: financial asset, financial liability, equity. That's all. So now let's get to the second leg of it, which is financial liability. Sir, if you know financial asset ka definition, you can construct financial liability ka definition on your own. What is the first feature of financial asset? Cash. Sir, can cash be financial asset? Can cash be a financial liability? No, cut it off. Second one is what? If you have invested in some other company ka equity shares, can it be a financial liability? If you make investment, means you only have obligation to pay. You have obligation, you have a right to receive cash. So can second feature of financial asset fit in here? Cut it off. So first two features, you cut it off. What was the third characteristic of financial asset? Contractual right to receive cash or any other financial asset. Here, reconstructed. Under financial liability, will we have a contractual right to receive cash or pay cash? We'll not have a contractual right, but rather we'll have a contractual obligation to pay cash or any other financial asset. Financial liability means we have a contractual right, we have a contractual obligation to pay either cash or any other financial asset to another entity. Okay. What do we mean by any other financial asset? Let's say we have a creditor. Let's say A Limited, they have a creditor worth 10 lakh rupees. A Limited told the creditor, I will pay cash 10 lakh rupees. A Limited told the creditor that I will pay cash of 10 lakh rupees. Is this scenario acceptable? Can they settle this creditor through cash or check? Yes. A Limited now told the creditor, boss, I don't have cash. Can you accept my company ka equity shares? Or let's say, instead of like this, A Limited told, I have investment made in Infosys. I have purchased some equity shares of Infosys. The current market value of Infosys ka share is 10 lakh rupees. A Limited told the creditor, can you accept Infosys ka shares? Creditor told, no problem. Infosys is a reputed company. Give it. I'll accept it. Now tell me, how are you settling this creditor? How are you settling this creditor? First of all, what is cash? Tell me, what is cash? Cash is what? Cash is financial asset. What about investment? What about investment? A Limited has bought equity shares of Infosys. What is investment in Infosys called as? Financial asset. Okay. Now, what did we pay the creditor? Did we pay the creditor in cash or we gave him some other financial asset? Did we settle this obligation by paying cash or some other financial asset? Some other financial asset. That also is possible. That's what is included in the definition over here. Financial liability means where we have a contractual obligation to pay cash or any other financial asset to another entity. Or we can also give, you have heard about this, no? You have in your foundation days and all, you have heard bill receivable endorsed. A Limited had a bill receivable. They gave that bill to creditors. Is that acceptable? That scenario only we call it as bill endorsement. Correct or no? So bill receivable is what? It's a financial asset. So you can settle that obligation either by paying cash or by giving any other financial asset. That's the first definition. Is that clear? Okay. Fourth one. What is the next feature of financial asset? To exchange financial asset, financial liability under what condition? To exchange FL with under favorable condition. Here it will be what? Favorable condition or unfavorable condition. Financial liability means to exchange financial asset or financial liability under unfavorable condition. That's okay. Everyone cool? Same example. Let's take up here. Let's say we have a creditors where we have to settle 10 lakh rupees. We have a creditor. We have to, let's say there is a company X Limited. They have to pay the creditor 10 lakh rupees. Creditor only, what do we call it as, sir? What is the nature of creditors? Creditor is a financial liability. Okay. X Limited also has a bill receivable. X Limited also has a bill receivable. Let's say the worth of that bill receivable is 10 lakh 20,000. The value of that bill receivable is 10 lakh 20,000. What is bill receivable for X Limited? What is bill receivable for X Limited? It's a financial asset, correct or no? Yeah. What did X Limited do? They endorsed this bill to creditor. They endorsed this bill to creditor, meaning this bill, they gave it off to creditor. Now tell me, this is a happy scenario or a sad scenario for X Limited? For X Limited, this is a happy scenario or sad scenario? Sad scenario. Why? Sir, we had to pay the creditor only 10 lakh. But we gave bill worth 10.2 lakhs. That means it is a favorable or unfavorable scenario. Then unfavorable scenario. Like that. Because we are paying more. No? We are paying 20,000 more to him. We had to pay only 10 lakh. But it looks like I paid 10 lakh 20,000. 20,000 more. Hence unfavorable scenario. So such a contract is also a financial liability. Favorable condition means financial asset, unfavorable becomes financial liability. Okay. Why would X do that, sir? X would saying why would X do that, sir? Sir, X has to pay. Y means again like that depends on X and credit arc arrangement. One reason you could say is, let's say we have to pay the creditor now. Okay, but we don't have cash. We have cash problem. But this bill receivable has a maturity term of 1 month. We told the creditor, take. Will you accept it? A creditor told, no problem. I'll wait for 1 month. That scenario quite possible. Instead of paying cash to him immediately, we are giving a bill receivable, but this bill receivable will get matured only after 1 month. Could be a scenario. Practically anything would work, sir. Now, you are transacted with Vijay Mallya or Nirav Modi. You have to receive, let's say, 10 lakh rupees from them. They told, I will only give you 7 lakh. Take it or leave it. What will you do? You will say, give me only 10 lakh. You will say, Devaru, God, give. Whatever, how much ever you want to give. I will take it from you. Yes or no? So that scenario could be anything. Okay, because if you feel that we may not recover any money from him, whatever we get, we will take and end the deal. Yes, no. So anything could work out practically. Okay, done. This is all right. This is one. Next, what is the next feature of financial asset we saw? Derivative. Derivative could also be a financial liability. Do not worry about derivative for the time being. Okay. It could be both financial asset or financial liability depending on what it is. If it's a gain, we show it as financial asset. If derivative leads into loss, it can also become financial liability. Little later, we will cover it. Okay, that's one. Another one is a non-derivative contract where entity may be obligated to give variable number of its own equity shares. This we will learn a little more when I do equity. For equity, there is a test to be fulfilled. Okay, let me not go there for the time being. Okay, this one I will put it on hold. When we look at equity, you will automatically understand that. Okay, so let's trace one step back. So what is the features of financial liability now? Can you help me out? Did we learn any new definition or financial asset only we adjusted? Whatever you learned it in financial asset, that only we adjusted, right? So what is the first feature of financial liability? Cut off cash, cut off equity shares of another entity. What remains? There it was contractual right. Here it will be a contractual obligation to pay cash or any other financial asset. That is one. Okay. Two, to contractual contract wherein you are exchanging financial asset and financial liability under unfavorable condition. That is another one. Third one, derivative contracts. Fourth one, you are giving your own company equity shares. You are giving your own company equity shares, but variable number of equity shares. The number of shares is not fixed. It is varying. Such a contract also becomes financial liability. Little more on this, I will talk about it. Okay. For now, put this on hold. You'll learn it. Okay. So let's take up some questions to test our understanding a little better. You will answer these questions. A Limited, that's the company, they makes purchase of steel for consumption in the normal course of business. Purchase they've done. The purchase terms provide for goods at 30 days credit, interest at 12% for the delay. So you purchase the goods means you have to pay creditor. No, they're asking what is the nature of this creditor. That's all. What is the nature of financial instrument? Creditor. What is it? You have a contractual obligation to pay cash. Obviously, financial liability. Simple one. Yeah. Financial liability. Great. Next question. A Limited, that's a company. They have made a borrowings from bank. They have taken a borrowing from bank, 10 lakh rupees from RBC Bank, it seems, with a bullet repayment of 10 lakh rupees. Bullet repayment means you will not repay the principal in many installment. You will repay it in one installment. Periodically, you will not repay the principal in one shot. You took 10 lakh in one shot. You will repay 10 lakh also in one shot. Interest you will pay periodically, maybe monthly, half yearly, yearly, whatever. Principal of 10 lakh, you will give it at the end of the loan term in one shot. Entire 10 lakh you will repay. Okay, that's what we mean by bullet repayment. One shot of 10 lakhs and an annual interest of 12% per annum. Every year they will pay interest at 12% per annum. Principal they will pay at the end of the loan term. Now company defaults at the end of 5th year. Till 4th year things were smooth. We were going on paying interest. Everything was okay. 5th year we defaulted. And consequently, a rescheduling of payment was done. We made some compromise arrangement with the bank. It's made at the beginning of 6th year onwards. The company is now required to pay 13 lakh at the end of 6th year for one-time settlement. Now the bank has told the company, pay 13 lakh, we will end our terms. When will this payment be made, sir? 6th year. Working as one-time settlement. How will you do this? What will you do this is what they're asking. Did you understand the scenario? Okay, first let's understand. I think this you may not have slightly got it. No issues. Sir, for first 4 years, answer my questions, few questions. For first 4 years, was there any drama? For first 4 years, was there any drama or everything smooth? Everything was going on smoothly, correct or no? We had to pay basically interest. Principal will pay at the end of the loan term. That is not a problem. Every year we had to pay interest. Did we pay? Yes. When did we default? Fifth year we defaulted. Okay. Fifth year only are we doing one-time settlement with the bank, or what did the bank tell? You have to do one-time settlement of 13 lakh when? At the end of sixth year. Correct, people? Now, can you tell me what is the loan balance at the end of sixth year? Because we are doing the settlement only at the end of year 6, no? Okay. Sir, how much loan did you take? 10 lakh rupees. Have you repaid this 10 lakh loan? No, principal you will repay only in bullet repayment. You have not done. Did you pay interest for year 5 or you defaulted? Interest on year 5 did you pay or default? Defaulted. How much is the interest they told? 12% per annum. So calculate, sir. How much will be the interest? 10 lakh ka 12%, which will be 1,20,000. Any problem? Basically, in the fifth year, we had to pay interest of 1,20,000. We did not pay. Okay. So far, good. Everyone cool with this, no? So how is interest calculated on 10 lakhs, sir? The interest we have to calculate on fifth year ka principal balance, no? No, that's not the way it works. Year 1, you just check. What was the opening balance of principal? 10 lakh. How much interest will you pay? At 12%. That will be 1,20,000. First year, did you repay any amount? Yes. This interest was repaid. So what will be your closing balance of the loan? You had to pay interest of 1,20,000 in year 1. You paid 1,20,000. So that means principal loan balance will be 10 lakh. So principal, every year, your outstanding principal loan balance will be 10 lakh only. Because interest you have paid, you know. That's the reason I've calculated directly fifth year ka interest on 10 lakh itself. Okay, no? Alright. Next. You are doing the settlement at the end of sixth year, no? I mean, sixth year also you have to pay interest. What will be sixth year ka interest now? What will be sixth year ka interest? Same, it is 1,20,000 itself. Yes, that's fine. Yes, 1 minute. In fact, 1 minute simply I'll do. Okay, how much is this, sir? 1,20,000 you do for year. Because it's a default. Actually, the arrangement has come to an end on fifth year itself. Another 1,20,000 you have to pay at the end of as interest. Correct? No. So calculate this. In fact, simply you could have done 10 lakh plus 12% plus 12%. 2 times. That's all. In fact, do like this actually. It will be better. Not like this. This will be wrong. Okay. 10 lakh plus 12% plus 12%. How much is this? Do like this. It will be 12 lakh. How much? My calculator is showing 12 lakh 54,400. Actually, it is not 1,20,000. That is wrong. 1 second. We'll calculate like this. Did you understand? Number is visible. Huh? 12 lakh 54,400. Everybody understood? This calculation, meaning what I'm doing here is, maybe if you want I can show it here in the table format also for you. Year 5. What is the opening balance of principal? 10 lakh. How much will be the interest? Interest at 12%. That will be 1,20,000. How much did you repay? In the fifth year, did you repay anything? No. So that means what will be the closing balance of the loan? It will be 11,20,000. Correct? Now, fifth year ka closing will become sixth year ka opening. So sixth year ka opening will be 11,20,000. Now you will calculate interest on 11,20,000 into 12% was that interest. How much was they told? Interest was 12%. Okay, 11,20,000 into 12% gives you 1,34,400. How much have you repaid? Nothing. So how much is your loan balance now? 12,54,400. How much did we get? Same number. Like this. Understood? Either you can put it like this in a table, or simply in your calculator if you do 10 lakh plus 12% plus 12%, that's okay. Hope that was not confusing. Fifth year ka interest is not 1,20,000. Interest on interest you have to pay, no? That is the reason. So hence interest will be more for this year 6. Confusion, guys. I told that initially wrong. That's the reason. Everyone okay now? Confirmation coding? Give. Clear, sir. So the loan balance, simply you do it like this in exam. That's good enough. 10 lakh plus 12% plus 12%. It'll give you the same answer. So loan balance is 12,44,400, or rather loan balance will be this much. Can I say so? But how much cash you have to pay as a one-time settlement, and how much cash you are paying as a one-time settlement and settling this affair? Is the bank asking you to pay 12,54,400, or what did the bank tell? Bank is telling you to pay you 13 lakh rupees. Okay, now check, carefully observe the screen. Loan means a company has taken a loan. Let's say whatever is a company, X Limited or Y Limited or whatever. Loan means the company has a contractual right to receive cash, or they have an obligation to pay cash. Loan taken. On loan taken, the company has a contractual obligation to pay cash. So loan is what? A financial asset. Loan taken is a financial asset or financial liability. Loan taken is a financial liability. Correct? Okay. Cash. What is the nature of cash, sir? What is the nature of cash? Cash is a financial asset. So are you not exchanging these two? Are you not settling loan by giving away cash? That means, are you not exchanging these two? You are doing an exchange. Correct? No. This exchange scenario is a happy scenario for X Limited or a sad scenario? This exchange, happy scenario or a sad scenario? Sad scenario. Why? Sir, loan balance is only 1254, but as a one settlement, we are doing it at 13 lakh. That means we are doing under favorable or unfavorable scenario. We are doing an unfavorable scenario because we are paying something extra. Correct or no? We are paying 45,600 rupees extra, in fact. So you are exchanging financial asset under financial liabilities. You are exchanging financial asset and financial liability under unfavorable scenario. So what is the nature of this contract? Such a contract is also a financial liability. That is what is this question all about. Understood? You're paying additional amount. So that means this is an unfavorable scenario. Such a contract also will be treated as financial liability. Do not worry about accounting aspect of it. There are some methods. We'll get to that. Okay. But now you got to know that this is also one of the characteristics of financial liability, because exchanging under unfavorable scenario. That's the reason. Any doubts or next question? Any doubts or next question? Or anything you want to copy means I'll wait. Yes, people. What do I do? Proceed. Some internet question is there. Some I'm not able to get. Next, they're telling. Okay. Next question. Actually, sixth question. No, it's actually a derivative question. You take it as homework. Don't do it now. Once I complete derivative question, go through this question, you'll be able to understand. For now, leave it. Don't have to worry about that. Come to question number 7. Okay, 1 minute. Hang on. Before I take up this question, I would like to spend some time on equity instrument. Then you will answer question number 7 for me. Okay, sir. Sir, financial instrument means it'll be one of the 3 components. What are those? Or it'll only give rise to 3 components. What are those? Financial instrument means either it could give rise to financial asset to one entity, or financial liability or equity to another entity. So financial asset we covered, financial liability we covered. Now we are covering what? Equity aspect of it. Okay, that's what they're calling it as equity instrument. So equity shares you already know. Sir, if favorable, not financial liability. No, sir. First criteria of financial liability is met. No. No, favorable means it will be a financial asset. You did an exchange. We're not talking from bank's perspective much. We are talking from X Limited perspective here. From X Limited perspective, they are paying more. No. If you are paying more means unfavorable. No. So unfavorable scenario means financial liability. That way. This 45,600 we are saying is an unfavorable scenario that you have to account it as financial liability. That way. Okay, this 45,600 you will account it under financial liability. How accounting works later we'll discuss. Like that. Now fine now. Okay. Equity instruments. Sir, can you tell me, I've already discussed once with you, what is the definition of equity shares? Can you tell me what does equity shares mean? Equity shares means what? Equity shares is an instrument that gives the holder right over the net assets of the company. Yes or no? Equity is an instrument that gives the holder a right over what? Right over net assets of the company, or you can also construct it as it gives the holder right over assets of the company after deducting all the liabilities. Okay, no? That is the first or the definition of equity shares. So if you are an equity shareholder, assets does not belong to you. If you have invested, let's say in Infosys equity shares, Infosys has a building. Building does not belong to you. If Infosys shuts down, they will sell the building. Whatever, all the assets they will sell. From those assets, first the outside liability holders, employees, creditors, bank loan, debenture holders, those guys will be paid. At the end, whatever is remaining, after settling all those liability, whatever remains, equity shareholders will have a right over it. That only we call it as net assets. So equity shareholders gets the right at the last. They rank last in the payment. That's one. Okay. All right. Second features, you write down few things over here. I mean, it's given, but given in big somewhere else. So just write 3-4 pointers. That should be good enough for us. Generally, equity shares are non-puttable. Equity shares are non-puttable. First write down, then we will see. And on equity shares, we have no obligation to pay cash. On equity shares, we don't have any obligation to pay cash or any other financial asset for that matter. Okay. And the last one you could say, consideration and number of equity shares are fixed. This we say fixed to fixed test. Fixed to fixed test should pass. Fixed to fixed test should pass. For you to classify something as equity, this fixed to fixed test also should pass. We'll spend some time on that. First, write it down. I brought it in the chart book, but here they've given big way. Just underline this. Know this. Yeah, Kamesh, if you're paying less in the previous example, if you're paying only 12 lakh, it will be a financial asset. Correct. If you're paying only 12 lakh here, that means it is not an unfavorable scenario. It becomes a favorable scenario. In that case, it will be a financial asset. Okay. Stick to this. Yeah. Okay. Have everybody written this down? Anybody still copying? We'll spend some time on this as well. Done? Still writing or done? Okay, check this, sir. First one, is it clear for everybody? Equity shares is an instrument that gives the holder right over net assets of the company. That's pretty much, you got it, right? All right. What do I mean by non-puttable? Everybody there, no? Keep responding, guys. If there's no response, I'll think that there's some tech issue. Keep responding. Yes, no, whatever. Okay. Generally, non-puttable. So, puttable means what, you know? We have something known as puttable instrument also. We'll be studying it. Maybe not today. Tomorrow session, maybe. Time up today. So, puttable instruments means, let's say A Limited. No, sir. They gave equity shares to Mr. X. They sold, A Limited gave its own company equity shares to X. Now tell me, can X sell the same shares back to the company? Company, they've allotted some shares to the shareholder called Mr. X. Does the shareholder have a right to sell the same shares back to the company whenever he wants? After 1 year, after 2 years, whenever he wants, can he do it? No. So if you have issued something, generally, no, if you are issued equity shares, the holder, can he sell the shares back to the company? The investor or the holder, can he sell the shares back to the company? No. Generally, equity shares does not have these features. If you have these features, we call such a shares as or such a equity shares as puttable instruments. Puttable instruments means the investor or the holder has a right, not an obligation. He has a right to sell the same shares back to the issuer, to sell the same shares back to the company. If such right is there, means puttable means to put back. Puttable means to put back. Now, who has put back means to give it back. Who has the shares now? Does A Limited have the shares? No, they've already given the shares to X. So, who can put that back? X. So, puttable shares means the holder has the right to put back or sell the shares back to the company. Or you could also simply treat it as buyback option. Do you remember buyback option? Okay. But buyback option and all, who has? The investor has it or A Limited has it? When we say buyback, company has buyback option. But in case of puttable instruments, X, the holder will have the right to put back or sell the shares back to the company at a particular price. That and all they would have agreed upon. But did we understand this? On equity shares, do you think this option will be there? On general equity shares, will we see this feature? No. So hence we say equity shares are generally non-puttable shares, because holder does not have this right to sell the shares back. Now, is that second part clear? Okay. Third, on equity shares, if company has issued equity shares, means should company has to do the buyback? Should the company has to buy back those shares? No, because equity shares, you have learned it in your FM also. Equity shares is a permanent capital. A company has no obligation to repay capital, nor do they have obligation to repay dividend. Yes or no? On equity shares, company need not pay the capital also back, or it need not pay dividend also. Everything is company ka marzi or company ka wish. If company wishes means they will pay dividend. If they feel no, I will not pay dividend in 1 year means can they do so? Very much yes. Correct or no? So hence on equity shares, we don't have any obligation. Company does not have any obligation to pay cash or for that matter, any other financial assets. Is this okay, everybody? Is this comfortable? Third definition, we don't have any obligation. So puttable option will be seen leases. Now, when we talk about puttable instruments here, we're talking about puttable shares. We will see puttable shares only. We have a separate section there. We will cover. Okay. We're not talking about what you will take on leases generally. Leases and all, you will take it on what? Tangible assets and intangible assets. For tangible assets and intangible assets, for PPs and intangible assets, will you apply financial instrument standard? No. So there are separate standard. In fact, you have taken them on lease means lease ka separate standard is there. India is 116. That will get covered. We also covered there. ROU is not a financial asset. Okay, because lease will talk about it. Okay, meaning I think 3 part is clear. This is important. The previous case study and the previous 1 point in financial liability I left. It gets covered here. Sir, if you want to classify something as equity, if you want to show something as equity in balance sheet, fixed to fixed test should be satisfied. Fixed to fixed test should be satisfied. What is this first fixed, sir? Sir, when company issues shares, let's say company issues 1 lakh equity shares of, let's say, face value 10, the issue price is 12 rupees. Face value of the share is 10 rupees, but they issued at 12 rupees. Tell me, what is the journal entry you are used to passing? What is the journal entry you will pass? A company has issued shares, 1 lakh shares, face value is 10, but they've issued at 12 rupees. 2 rupees premium. What's the journal entry? Bank account debit 1 lakh into 12, which is 12 lakh rupees. What will you credit? To equity share capital shown at face value. So 1 lakh into 10, which is 10 lakh. The premium element goes to securities premium, which is 2 lakh. This is the entry you'll pass. Correct or no? Everyone? Now tell. How much money did you receive how much money did the company receive when they issued those equity shares? How much money in totality the company received by issuing these equity shares? 12 lakh. Was there any problem in getting to know this number, or this number is freezed? Is it changing or is it fixed? It is fixed, correct or no? You issued the shares means how much money you will receive, that is fixed. That is what we mean by sale consideration. By issuing equity shares, how much money you will receive, that should be fixed. That is the first portion. Did we understand? By issuing equity shares, how much money you will receive, that portion should be fixed. 2, number of shares also should be fixed. Here, how many equity shares did you issue? 1 lakh. Is that varying or fixed? Fixed. So if these two are fixed, then we say fixed to fixed test is passed, and you can show this instrument as equity in your financial statements. Understood now? The consideration and the number of equity shares both has to be fixed for you to classify something as equity. Done, people? Sir, can it vary, sir? Yeah, it can vary also. Sir, if it varies, what to do, sir? If one of this test fails, sir, for you to classify it as equity, both the tests should pass. Even if one fails means, even if any of them fails, any one fails means what do you do? If any one of this fails means you will not show it as equity, you will show it as a financial liability. That was one of the features of financial liability, which I had put it on hold. Is it fine? Both should be passed. If any of them fail means the classification will not be equity. The classification will become financial liability. Sir, give an example. Why give an example? We'll take a case only. We have a problem only. Question number 5. Can I take a question number 7 for us to understand it better? But before that, tell me what are the features of equity instrument, sir? Equity instrument means it's an instrument that gives the holder right over what? The net assets of the company, or right over assets of the company after deducting all the liabilities. And equity shares generally are puttable or non-puttable. Equity shares are generally non-puttable. Puttable means what? The investor or the holder has a right to sell the shares back to the company. Such feature generally you don't see it in equity shares generally. Okay, that is one. And the third one is on equity shares, company does not have any obligation to pay cash or for that matter, any other financial asset. Fourth one, for you to classify it as equity, fixed to fixed test, F to F, fixed to fixed test has to be passed, meaning the consideration and the number of shares has to be fixed. If any of them fails, you cannot classify it as equity. Financial liability would be the classification. Let's go through question number 7. Target Limited took a borrowing from Z Limited. So Target has taken a loan. So loan taken means asset or liability? Loan taken as a liability, no? Looks like a financial liability because we have an obligation to pay cash. Okay, 10 lakh rupees. Great. Z Limited enters into a arrangement with the Target Limited for the settlement of loan against the issue of certain number of equity shares of Target Limited. So Target has taken a loan. Rather, you could say Z Limited has given a loan to Target. So for Target, it will be loan taken. For Z, it will be loan given. Okay. Now, these two guys have entered into an agreement saying what? The settlement will be made against issue of certain number of equity shares of Target Limited. Target Limited is saying, I will not repay your loan by paying cash. I will repay your loan by giving my company car equity shares. Did you understand that scenario? If Target has taken a loan, instead of repaying loan in cash, we are repaying in the form of shares. Good with this so far? Work. Next, what are they saying? By issuing certain number of, which number they've not given, okay? Certain number, the keyword there is that. Certain number of equity shares of Target whose value equals 10 lakh. So, the arrangement is such that Target is telling, I will give you that many number of shares whose value is 10 lakh. I will give you that many number of shares whose market value is 10 lakh rupees. Why 10 lakh? Because the loan taken value is 10 lakh rupees. Okay. So I will give you that much number of shares whose value becomes 10 lakh rupees. That's what is their arrangement. For this purpose, fair value per share, total number of shares to be issued, shall be determined based on the market price of the share at a future date. Whenever you are doing a settlement, no, you will use, will share price be same, sir, or it will fluctuate? Will share price be same or it will fluctuate? It will fluctuate. So that's what they're saying. Whenever Target Limited has to settle this loan, no, that day they will check the market price of the equity shares. Based on that, how many shares will be issued will be decided. Number of shares is not yet decided. The number of shares is based on what now? The number of shares is decided based on the market price of the share. Okay, then that's what they're saying over here. Okay, I'll read that sentence once again for you. For this, the fair value of the share price shall be determined based on the market price of the share of Target Limited at a future date, on the settlement date. Evaluate this under the definition of financial instrument. Tell me, sir, what is this? Simply you think, in this example you think, company issued 1 lakh shares, face value is 10, IP is 12. Can they pass this entry? They pass this entry. Now, let's say this entry you passed on 10th April 2024. On 1st May 2025, the market price of the share became 25. Will company pass any more entry for this? When the shares was issued, it was issued at 12 rupees. 1 month later or 2 months later, share price became 25. Will company bother about share price anymore? After you have issued the shares means, will company worry what is the market price of the share? It could be 25, it could be 5, it could be 250, doesn't matter, yes or no. Once we have issued the shares means our accounting entries are done and we freeze that. Correct, people? Okay. Is that happening in the case study we just now learned? No. What is happening here? We will issue shares. Okay, you're issuing shares. Perfect. But is fixed to fixed test satisfied? Fixed to fixed test means how much is the value of the share should be fixed and how much is the number of shares should be fixed. Here, consideration is fixed. You will give shares worth how much? You will give shares worth 10 lakh rupees. That is okay. That is fixed. One portion is fixed. Is the number of shares fixed? Is the number of shares fixed? No. Number of shares is not fixed because number will vary based on market price. Like here, look at this example. Suppose on the settlement date, you have to totally settle how much? 10 lakh. Suppose the market price of the share on the settlement date is 100 rupees. On the settlement date, the market value of one share is 100 rupees. Can you tell me how many shares will the company issue? To settle the loan, how many equity shares will they issue? Totally they have to settle 10 lakh rupees. And the market value of one share is 100. That means I think they'll give you 10,000 shares. 10,000 shares will be settled or 10,000 shares will be issued. Are we fine? Suppose the market value of the share is 50 rupees. If the market value of the share is, or let's say market value of the share is only 10 rupees for simplicity, then can you tell me what is the number of shares? You have to totally settle 10 lakh. Value of one share is 10 rupees. That means how many shares now you will give? 1 lakh. Is this number same or changing? Is this number same or changing? Fluctuating based on what? Market price. So is the number of shares fixed or fluctuating? Fluctuating. So fixed to fixed test, passed or failure? Failure. Hence, can you classify equity shares that you're planning to issue? Can you classify it as an equity? This contract where you are giving equity shares, can you classify these shares as equity? No, it will be classified as what? Financial liability. Because you think practically. If you have really issued equity shares means, will you worry about market price? If you had really issued equity shares means, will you have worried about market price? No. Here, your main concern is, you know what is the main concern over here? Somehow I have to pay 10 lakh rupees. Somehow I have to pay off 10 lakh rupees. If market value increases means I will give less number of shares. If market value decreases means I will give more number of shares. That means, can I say like this? You are using equity shares as a currency, can I say? You are using equity shares as a currency, or somehow you have to pay 10 lakh rupees. Instead of paying 10 lakh rupees in cash currency, you are using this as equity. Yes or no? So basically, equity shares are used as currency in this particular scenario. Equity shares are used, that's how you'll write in your case study, are used as currency. Hence, you will classify this as what? Financial liability. They have given the answer over here also. That's also written over here. Equity shares are used as a currency. Hence, it will be classified as a financial liability. Understood the meaning now? That fixed to fixed test and all that. Done or not, sir? Yes, sir. That was what there in your financial liability also. If you remember in financial liability, one component we had missed out. Here, a non-derivative contract where entity is obligated to deliver not a fixed number of equity shares. They're giving their own equity shares, but it is not fixed, it is variable. If number of shares is varying means, can you classify it as equity? No. In that case, the classification will become financial liability. That is your this definition. Done. That's all. All right, let's understand this a little better. A couple of more numbers we will go. And a couple of extra questions I will solve and then we'll wind up. Okay, quick ones. Silver Limited, they've issued irredeemable preference shares. So redeemable means what? You have to repay. Irredeemable means, do you have an obligation to repay the capital back on these preference shares? No. So that means there is no obligation, can I say so? On these, to repay the capital. Can I say so? Okay. There is no obligation to repay capital. Then let's see further. The face value of 10, they've issued at 90 rupees premium. Great. These shares carry dividend at 10%. Okay. However, dividend is paid only when Silver Limited declares dividend on equity shares. That means you tell me, on these preference shares, does the company have obligation to pay dividend? They don't have obligation to repay capital. At least do they have obligation to pay dividend? No. They will give dividend to these shares only if dividend is declared on equity shares. If dividend is not declared on equity shares, then company does not have obligation to pay dividend on preference shares also. That means no obligation to repay capital, no obligation to repay dividend. That means company does not have any obligation at all. Tell me, what is the nature of this preference shares? Guys, normally in your CA intermediate, you used to show preference shares as a separate category. You used to show equity shares, preference shares, debentures like this, right? Now onwards, preference shares, there is no separate category. Preference shares, either you will classify it as equity or as a financial liability. Welcome to India's world. Substance over legal form ka accounting. You may call it as preference shares, but preference shares will be shown in the balance sheet either as equity or financial liability. If it has equity features, you will show it as equity. If it is not equity, automatic classification will be financial liability, like that. Okay, sir? Understood? That's where this question is built. Done, done, not done? Substance over legal form ka accounting. Meaning reality is more important than legality, like that. That's how the accounting works here. Now here, just check. You may call it as preference shares, but on these preference shares, is the company having any obligation to repay capital? No. Do they have at least obligation to repay dividend? No. That means it has equity features, financial liability features. Which feature? Though you're calling it as preference shares, it has what features? It has the features of equity. So you will classify it as equity. Last line, they have told somewhere. This preference shares meets the definition of equity instrument. Okay, na sir? That's all. Don't worry about drama. If they ask 5 marks and all, how will I answer? First of all, they will not ask. If at all they ask, equity ka features. I gave you 4 features of equity. Write that down. That you will write in the first point. Then you will say, there is no obligation to repay capital, no obligation to repay dividend. Hence, it has equity features. So you will classify these preference shares as equity. Those sort of direct questions are rarity. Just in case they ask, you can write it like that. Can I go for next question? Sir, if obligation to pay dividend is there, what to do, sir? Next question. It is there. Okay. 1 minute. That's the reason. Don't overthink in these topics. Whatever you're thinking, everything will come. There are a lot of things over here. Just stick to the things. Yeah. Everything. Whatever you're thinking, whatever you're not thinking, everything will come. You need to have a little more patience here in this topic, especially. All right. Okay. Just check this. In the previous problem for Z limited, what it is, sir? Where is Z limited? Z limited. For Z limited, what it will be? Sir, Z limited, what is Z limited doing here? They are receiving equity shares of target. They are receiving equity shares of another entity. Equity shares of another entity is a financial asset. Correct. Z limited is a financial asset. Perfect. Correct. Because equity instruments of another entity, if you have invested in equity shares of another entity, it's a financial asset. Correct. Okay, come to this question. A limited invests in compulsorily convertible preference shares. Compulsorily convertible means it will get converted into equity shares. Yes, no, we don't have obligation to repay the capital. We will convert this preference shares into equity shares. Okay, at some value they've given. Okay, under the terms of instrument, each compulsorily convertible preference shares will be converted into 1 equity shares. So how much you will convert? Do you know how much you have to repay on conversion? Yes, they've given the value over here. Okay, how many shares will you issue on conversion? Do you know? Yes. On each convertible preference shares, you will give 1 equity shares. So it's fixed to fixed test getting satisfied. How much you have to repay also, you know. How are you repaying? In how many number of equity shares? Do you know that? Yes, that is also fixed. Correct or no? 1 equity shares for every convertible preference shares. Fixed. Okay. Such CCPS, compulsorily convertible preference shares, carry dividend at the rate of 12%. Payable, okay, let's read that further. Payable only when declared at the discretion of B Limited. So on these preference shares, no, 1, they are compulsorily convertible. Compulsorily convertible means it has what feature? Financial liability feature or equity feature? Equity features, because we don't have obligation to repay the money in the form of cash. It will get converted into equity shares. That is 1. And fixed to fixed test is getting satisfied. And 2, on these preference shares, should you have to pay dividend? Yes, you have to pay dividend. Compulsorily or our obligation, our choice. Company's choice. If they at the discretion of company means company choice. If they want, they will pay, otherwise no. That means, do you have obligation to repay capital? No. Do you have obligation to repay dividend? No. So what is this nature of this financial instrument? This will be classified as equity. That's all. This preference shares will be classified as equity. Awesome. Everyone is getting, I hope. 10th one is homework. It's a derivative question. Don't do it now, later. 1 minute. Another 1 or 2 is there. Quickly we'll do off and wind up. 11th one. A Limited. They have issued preference shares to B Limited. Great. Those preference shares are redeemable. Redeemable means? Can you escape? No. We have to repay preference shareholders their money back. So we have an obligation to repay preference share capital back. Can I say so? So we have an obligation to repay capital. That's 1. At 10 years from now. Okay. And it entitles a holder a dividend of 15% also. Okay. Tell me, sir. We have issued a preference shares. On that preference shares, we have to repay the capital also. We have an obligation to repay capital also. We have an obligation to pay dividend also. On equity shares, do you have obligations? On equity shares, do you have obligations to repay capital and dividend? No. But in this problem, do you have obligations? Yes, both to repay capital and to pay dividend. Now you tell me, how will you classify these preference shares? Since you have obligations, these will be classified as financial liability. Done? Here the classification of these preference shares will be financial liability. Okay, last question for the day. One second, Macha. You are always going for two steps ahead. Hang on. Check here. Next question only, you just check. P, P Company Limited, they have taken a loan from Q Limited. They have a loan from Q Limited. The loan is perpetual. Perpetual means you have an obligation to repay loan. You have taken a loan. Okay. But should you have to repay that loan, or this loan goes on forever? It goes perpetual means this loan goes on forever. Sir, what goes on forever? Financial liability goes on forever or equity goes on forever? Equity goes on forever. Yes or no? That means the perpetual portion of loan represents which feature? Equity feature. Can I say so? Since loan is perpetual, it has features of equity. Am I right in saying so? Everybody pay attention to this and tell me the answer. Am I right in saying so? Yes. But it entitles the holder fixed interest rate of 8%. But the company has to pay interest. Loan ka principal you don't have to repay. Perpetual. So that is equity feature. Okay. But on this loan you have to pay interest. Interest means we have an obligation to pay cash. That means this interest gives rise to what feature? Financial liability. That means this instrument has both equity and financial instrument. This we call it as compound financial instruments. What to do for that? I will tell you. You need to do split accounting. Perpetual portion of the loan, you will book it as equity. Interest portion of the loan, you will book it as financial liability. If instrument has both equity and financial liability features, you have to split. How to split? There are some measures that I will tell you. Not now. Maybe tomorrow or day after. We'll come to that. Done now? So an instrument could have both features, equity and financial liability features. Done? So an example. So continuously you are hagging me without an example. No? I'll take up that example. I'll give you the company has issued preference shares. Okay. This preference shares, no, they will convert it into equity shares. That means, does the company have obligation to repay capital? Company has issued preference shares. They'll convert this preference shares into equity shares. So does the company have obligation to repay capital? No. That means this has what features? This is the feature of equity. Because on equity, we don't have obligation to repay capital. So this portion will be equity. Agreed? But the company has to pay fixed dividend of 10% every year. No escape. Company has to pay dividend on these instruments. That means company has obligation to repay dividend. This obligation to pay dividend represents which feature? The obligation to repay dividend represents financial liability feature. That means this portion you will classify it as financial liability. This portion you will book it as equity. This we call it as CFS, compound FI, compound financial instruments. Meaning those instruments which has features of both equity and financial liability. What to do? How to do? Going forward sessions, not now. Okay, everybody? So yes, so that was the thing with respect to our, or let's do a thing. Let's 2 minutes, quickly let's recap. We only learned 3 things. Let's quickly sum up everything. So far, whatever we have done, any doubt is there or all okay? If all is okay, quickly I shall summarize things. No doubt, no? Everything okay? Everybody? Okay, all right, let's come back. So we started a topic called financial instrument. Financial instrument means it's a contract which gives rise to financial asset to one entity or financial liability or equity to another entity. That is one. Financial asset means what, sir? Cash including bank deposits or equity instruments of an other entity. Third, contractual right to receive cash or any other financial assets from an other entity or to exchange financial asset or financial liability under favorable condition. Derivative or a non-derivative contract where you will get variable number of your own equity shares. That is one. Then your investment or rather your intangible assets, inventory are not financial assets. All right. Then we looked at financial liability. Financial liability features is what? Financial liability is a contract where you have a contractual obligation to pay cash or any other financial assets. Okay, then to exchange financial asset or financial liability under unfavorable circumstance. And then derivative or you have issued your own company equity shares. A company has issued their own company equity shares, but that fixed to fixed test is not passed. If fixed to fixed test is not passed, then you will classify that instrument as a financial liability. That one. Then equity. Equity is an instrument that gives the holder right over net assets of the company. They are generally non-puttable, meaning the holder does not have a right to sell the shares back to the company. Okay. And on equity shares, we don't have obligation to repay the capital or dividend, meaning we don't have any obligation to pay cash or any other financial assets. Okay. And for you to classify it as equity, fixed to fixed test has to be passed, meaning number of shares and the consideration, total consideration, both has to be fixed. If any of them fails, you cannot classify it as equity. Classification will be financial liability. If an instrument has both equity and financial liability feature, then such an instrument we call it as compound financial instruments, where we have to do split accounting. Some portion of that will be accounted as equity, some portion will be recorded as financial liability. Okay. So that's about the quick revision on, the summary of today's session. Thank you.